Welcome to the Point Podcast. We have informed, intelligent conversations about today's financial topics submitted by viewers like you. Let's go ahead and get started. Here are your hosts, Landis Wiley and Allen Wallace.
Hello, and welcome to today's episode of The Point. I'm your host, Landis Wiley, sitting here as always with my illustrious colleague, Chief Investment Officer, Allen Wallace.
Hello.
Allen, how you doing?
Doing great.
Happy holidays.
They made it cold in here for me, and you're probably shivering.
Perfect. Well, I have layers. I always come in layers.
There you go.
So it's perfect. Big news today. Big anniversary for us.
Yes.
20th episode.
I know. I can't believe we made it this far.
I know, it's unbelievable. They haven't fired us yet, so they must be doing okay.
That's right.
So if you've tuned in for all 20, we appreciate it. Thanks, Dad.
And Mom.
So, no, it's great. We really appreciate you being here. It's been a lot of fun getting through these 20 episodes. And, hopefully we'll have a whole lot more to come. But
that's right.
We'll kind of get rolling. So there's been a lot going on. Turned the calendar to 2026.
Right.
So, markets were a little wild over holidays. Lots of world news going on. Lots of things to kind of keep everybody on their toes. But I know one of the things that drew a lot of attention towards the end of the year last year, which is sort of our, opening talk here, is what in the heck is going on with silver?
Yeah. Yeah, it's sort of been scraping along the bottom for years, and now all of a sudden, it was up 160% last year. I think we started buying it around 25, and today it printed 81. So, not to break anyone's heart, but that means it's time to rebalance. We started with about a 4% exposure, and that's crept its way up closer to 12, which is way too much exposure to have. So we are trimming it back down to model. That has nothing to do with what I think is going to happen to the price. The point is that if the price keeps going up, we're still going to benefit. But it's just, you can't have 12% of your portfolio in one metal. It's a very volatile commodity. The cool thing about silver is that it's both a precious metal and an industrial metal, right? It's used in all these new electric cars and on semiconductors and switches and all those sort of things. So we're sort of running a shortage. So I don't make predictions about price fluctuations. I have no idea. But I still want to have exposure to it because of its dual purpose as a precious metal and as an industrial metal. So I guess that's the update.
Okay, perfect. And obviously, silver industrial purpose, you mentioned semiconductors, that's been a big headline. We've talked about that on prior episodes, sort of what's going on with AI and what's going on with these semiconductor and chip companies. So, it's not a completely random happenstance that silver's price has done what it's done. But to your point, metals in general are just very volatile and kind of unpredictable.
Well, and the dual industrial status also has a downside, which is if we hit a recession, then that is bad. Right. And so with the price up 160% and almost 200% from where we started buying it, and that extra exposure, with a downside risk of 50 or 60 or 70%, we definitely don't want to have more than 10% of someone's portfolio in that.
Right.
So it's purely an asset allocation decision, not a timing decision. I have no idea what will happen with the price. I hope it keeps going up because we have exposure. But at the end of the day, we have to manage risk. A lot of our clients are retired, and they can't afford to have that kind of volatility in their portfolios.
And there is an element of geopolitical risk.
Absolutely.
With silver, right?
Yeah. I mean, it's an international currency, really. It's demanded by everyone, especially industrial nations. And so, it sort of exists outside the currency system. And so, we want to manage our exposure and make sure we're not, over allocated.
Right. So it's that classic idea of kind of investment, fundamental principles of buy low, sell high, don't get greedy.
Yeah. Well, so the problem with a commodity like silver is that I don't have any sort of income to try to calculate a fair value. If it generated some sort of monthly yield, I could say, well, it's yielding 5% or 6%. Well, we don't have that. We only have two cash flows in a metal. We have when we buy it and when we sell it. Everything in between is just volatility. So there's really no way to say it should go higher or it should go lower. It's very difficult to try to put a valuation on it. So we really just have to control how much exposure we have.
Right. All right, perfect. Well, stay tuned on it.
That's right. Yeah.
So, perfect. With that, we'll be right back after a short message from our sponsor.
What does your ideal retirement sound like? Travel and adventure? Indulging in your hobbies? More quality time with the people you love? Or maybe all of the above? Let the experienced advisors of Basepoint Wealth help you create your ideal retirement roadmap. Our fee-only advisors provide independent and transparent wealth management advice to clients throughout Iowa and beyond. Ready to see what your retirement can be? Visit basepointwealth.com to book your consultation with a Basepoint Wealth advisor, because from here, you can go anywhere. Basepoint Wealth is a registered investment advisor. Visit basepointwealth.com for important disclosures.
All right. Well, welcome back to The Point. Again, thanks for joining us for our 20th episode here. And
we should have had cake.
Should have had cake?
Yeah.
Man, I had so many sweets over the holidays.
That's true.
I don't know that.
We should have had celery.
Celery. Okay. With that, we'll kind of transition into the meat and potatoes.
Okay.
To go back to, I guess, holiday dinner here. We'll get into our topic of the day, which in I guess recent episodes, we've had a lot of questions, a lot of inquiries, a lot of topics around what's going on in the market.
Right.
2025 was a very busy year, a lot of ups, a lot of downs, a lot of noise in the headlines, right? So that was sort of top of mind to folks. We did just get done with our year in review market update. So for those that didn't catch that, it's up on our website and on our social media channels. So be sure to check that out if you're curious about, what happened last year in the markets, why things did what they did, and sort of how Basepoint's handling the money. But today we're going to shift a little bit. We're going to take on a question that's much more focused into the planning realm, which is really where Basepoint spends probably the bulk of its time.
Yeah, I mean, a lot of these topics end up being about investments, but we're planners first. So I'm glad we got a question that allows us to talk about that.
Right. So the question that we got, and I'm going to kind of paraphrase this a little bit. Question that we got here was, what are some common mistakes that you see people make specific to retirement?
Okay.
Right. And it kind of went on and branched into a couple different questions around 401k allocations and things like that. But we'll just kind of broadly summarize it as, issues or mistakes that we see people commonly make around retirement.
Sure. So, well, the biggest one and the easiest to correct is not saving enough money. But that would make for a very short discussion.
Right. Right. So this is something, as financial advisors, wealth managers, planners here at Basepoint, we see this a lot in our conversations with clients, particularly for folks that are coming in and maybe working with an advisor for the first time, or people that have, worked with somebody for a long period of time and maybe, have questions. Oftentimes those questions really boil down to considerations that involve tax planning.
Yeah, right. Especially for do-it-yourselfers, right? They may have picked up a few things randomly, but they've never really built a comprehensive financial plan that takes all the different gears into account. Right. We've got a lot of moving parts in a financial plan. And if you've only focused on a couple of those different areas, you might have some pretty big gaps,
right?
Which is what we see, right?
Right. And generally speaking, I think the average person should do X when it comes to, if you Google retirement planning, you get all kinds of articles and commentary and studies that talk about what the average person should do.
Right. And those are especially dangerous when they use numbers.
Right.
There's that old saying that, 70% of people think that they're better than average at driving. Well, the majority of the people that we work with are much, much higher than average.
Right.
You and I had talked about some statistics just to kind of give people some bearing on what is average.
Right.
So, and this is your area of expertise, not mine. You're the planner in the room. So
yeah, but I'm the host. You're the one that's supposed to be.
Maybe I should be interviewing you.
Yeah. So maybe let's talk about that, right? Because I think a lot of the things that maybe people watching today, and certainly, I think if you talk to any of our advisors, what they would say when people initially come in and are looking for answers, it boils down to they've got a lingering maybe doubt that what they're doing or what they have done is correct. Right. They feel like, I've been doing stuff, but I want to stop working. Right. I want to retire. I want to help my kids, or I want to go travel and see my grandkids, or whatever it is that they want to do. It boils down to they're just not sure if they've done the right things. And in the planning process, a lot of times that starts from our standpoint by asking the question, well, what have you done?
Yeah,
right?
exactly. Right.
What do you have and what have you done? And through that conversation, it often comes out of, well, I did this because I saw something where somebody told me that the average person should focus on saving X, right? Or doing it in this way, right? So it's, it's always focused on save more, right? It's always the first line of kind of advice that people get or thing they read.
Right, and this is coming from the brother-in-law or the neighbor or the internet message board or, those type of places.
Right, right. And so, and you get into the thing, this, and I think we've talked about this in prior episodes, the Warren Buffett statement of years ago about the average person should just put all their money in the S&P 500 and forget about it, right? Or the average person should maximize their 401k or put all their money into Roth, right? And buried within there is the average person.
Right.
And I guess the question is, well, what's the average person?
Yep. And you've got some numbers on that, right?
And I've got some numbers on it.
Yep.
So fancy me, look at me being prepared. So, according to lots of resources, so Census Bureau, various financial institutions out there, they study this type of stuff. So the average retiree in the United States between 62 and 65.
Okay.
The average income for a retiree, and I guess average meaning mean, kind of the middle, right?
So this is median, not mean, right?
Right. Yep.
Yeah, okay.
Yep. So the average household income for a retiree is somewhere between 55 and 75,000, depending on how you want to calculate that.
Okay.
Right?
Including Social Security.
Including Social Security.
All right.
Average Social Security check is about $2,000 a month. Okay. Average investable assets is around 200,000.
Okay.
Average net worth is around 400,000.
Wow.
Okay. So when you stop and think about that, and then you think about the advice and articles and things that are written for the average person, or the statements from Warren Buffett, that's who they're talking about.
Right. And that doesn't include most of our clients.
And that doesn't include most of our clients.
Right.
Right. So the difficult thing, I think, for a lot of people out there is if you're the average person, you don't have a lot of complexity around tax planning.
Right.
Right. But if you're a person who is, aiming to retire at 55 or 60 years old, it means you likely have assets accumulated that are well beyond that 200,000 investable assets number,
exactly.
right? It likely means that you have household income well in excess of $55,000 to $75,000 a year.
Mm-hmm.
Because frankly speaking, if you don't have wealth accumulated or income in excess of that, you likely can't afford to retire until you can get your Social Security check.
Right. So where do we start then?
Yeah. So where do we start? So I think, where I would come at it is be really careful about reading things for the average without understanding what you're reading for.
Mm-hmm.
Right. So let's take a step back and think about maybe 401k savings.
All right.
Okay. Let's start there. So most people know, and they have the goal of, I want to save more. Right. So you start out, you're scrimping by, you're trying to raise kids, you're trying to buy a house, you're spending all the money, right? And your goal first and foremost is, well, let me put in enough to get the employer match.
Right.
Right. So people start saving, you've got that initial decision of pre-tax versus Roth that you make.
Right. And conventional wisdom always says,
well, it depends.
Yeah.
Right. 20 years ago, it was all pre-tax, more or less.
Yeah.
Right? So a lot of people, especially those that are approaching retirement age, they started in an era where you didn't have Roth.
Right.
So they may have just set it up.
Yeah. I don't remember when the Roth 401k came out, but it was during my career. So,
right.
Yeah.
So, that for a lot of people, they set this up. Maybe they've increased their contributions every year. It's continued to just plow money into a pre-tax 401k. For most Midwesterners, the majority of their wealth is in their retirement plan.
Yeah, isn't it like 80% or something like that?
Right. So, you get to this point as a person looking to retire where the vast majority, if not all of your liquid wealth is essentially in a pre-tax account.
Right.
Right. Which that can present some tax challenges.
Well, sure. Yeah. I mean, it really limits your flexibility, right? So all of your income that you need to take has to be put on your tax return.
Right.
So what kind of problems does that cause for people?
Well, see, you keep kicking this back on me.
Well, you're the expert.
I guess, yeah. So, really what you're thinking about from a tax planning perspective, and you're the CPA here, so you can correct me if I'm wrong on this one. See, this is how I'm going to turn this back around on you. So, people focus a lot on marginal tax rates. Right?
Yeah.
I mean, the
1 year's marginal tax rate.
1 year's marginal tax rate.
Right.
You go and you file your taxes and you're like, oh, I was in the 22% bracket or the 24% bracket.
Right.
From a tax planning perspective, though, it feels like the focus should be more on our effective tax rate.
Yes.
Right. What's the average tax that we're paying on every dollar of income that's flowing
Over your lifetime.
over your lifetime?
Not over 1 year.
Right.
Yeah.
Most people, when they work, you start out at a relatively low income. You progress through your career.
You've got kids.
You've got kids.
You're paying mortgage on your interest, or you're paying interest on your mortgage.
Right. So you've got a lot of things that happen, but fundamentally, there's data out there that shows your peak accumulation years, your peak earning years are in the last 5 to 10 years of working, right?
Yeah.
So for most people, you may start out your career at a relatively low effective tax rate, right? You've got lower income, you've got more expenses, you've got mortgage interest that you can deduct, you've got child tax credits, you've got all kinds of things.
So
right?
all that makes it sound like you're better off paying the taxes then.
It sounds like you're better off paying the taxes, right?
So that would be the Roth 401k.
That'd be the Roth 401k. As you get later on and, kids leave and you lose the child tax credits and, mortgage is paid off, you don't have the interest deduction. And now instead of household income of, 60 or 70 or 80,000, now it's 100 or 150 or 200 or 300,000. All of a sudden that effective tax rate, in the latter years of working might be 20, 25, 30%, right?
Sure.
In some cases. And then we stop working, right? And once we stop working, now we've got to go draw from our assets. We've got to draw from Social Security. Most people don't need to replace 100% of their working income.
Well, yeah, because they were saving.
They were saving.
They were paying mortgage interest.
You were paying FICA. You were paying Medicare. The average person probably, lives on 50% of their gross pay, right? So you get in this retirement phase where you go from a relatively high effective tax rate to, if all I'm drawing out is what I need to live on, right? Because I don't need to continue to fund a 401k. I don't need to continue to fund a Roth IRA. So now my income is very much aligned with my expenses. What happens to my effective tax rate? It's likely going to drop.
Right.
Right. And for many people, especially those that have prepared well, the distribution rate is likely well below the rate that's going to draw down their assets over their lifetime. And then, which is great, right? Our accounts continue to grow. We're drawing our income, our effective tax rate. We feel great because we're not paying as much into Uncle Sam. It's awesome. And then the government does a little something to us at, 73 or 75, depending on how old we are.
Yeah.
And they basically start looking at your pre-tax savings and they say, well, wait a minute.
We'd like our share.
We'd like our share.
Yeah.
Right. And all of a sudden, even if maybe I only need $5,000 or $6,000 or $7,000 a month to live on, the government's going to look in there and say, well, you've accumulated by this point $1.5 million or $2 million or $3 million in pre-tax money. You need to start taking out about 150. Right? Well, what's that do to your effective tax rate?
Yeah, it goes up.
It goes up.
It causes your Medicare premiums to go up.
Right. Which doesn't show up in effective tax rate.
It causes your Social Security to be taxed.
Right.
All those things start happening in your 70s when you're on spend down. So
right.
So what can we do to avoid that then?
Well, I think it comes back to, addressing this question of how should we be saving up front, right? And it probably moves beyond the basic just save more, right? Just because you can max out your 401k, I guess it's $24,500 now with the new number. Plus,
if you're under 50.
If you're under 50, plus another $8,000 if you're over 50.
Right.
And a whole bunch of other little workarounds in there. So it probably moves beyond just save more. And it probably begs the question to more people out there that says, well, how should you be saving that?
And the answer is it depends, right?
Right.
Because it depends on what tax rate you're in, what your age is, when you plan on retiring, what your monthly lifestyle will need to be. So we can't really give practical recommendations that will satisfy everyone.
Right.
And that's kind of why you need to work with a planner.
Right.
But I think what we can talk about is what that progression looks like. So, a lot of people fantasize about retiring at 55. You've got some decisions to make at 62 with Social Security. You've got Medicare at 65. You've got qualified charitable distributions at 70 and a half. Then you've got RMDs depending on your birth date in your early 70s. So, as a planner, let's walk through that a little bit. So, and let's keep it general so that, we're not giving specific recommendations to any one person. But so let's say I'm going to retire at 55.
Right.
I've got a bunch of money in a 401k. What are, What do I need to be concerned about?
Right. Well, first and foremost, you've got the challenge of the 59.5 rule.
Right.
Right. Which essentially says that if you start drawing from qualified assets before you've reached 59.5, you're going to obviously claim that as ordinary income.
Right.
Pay federal taxes and possibly state, depending on where you live. Iowa, which obviously is, where we're sitting, no longer taxes those distributions at 55.
Right.
But that's not true in a lot of states. But then they'll ding you with the extra 10%.
If it comes out of an IRA.
If it comes out of an IRA.
Right.
Right. There is some flexibility if you take the distributions out of a 401k, right, at 55.
If you've retired after.
If you've retired after 55. Yeah. So, first and foremost, you've got sort of that consideration, which says, well, how did you save the money that you're going to use to fund lifestyle in retirement, right? Which gets back to, where did you direct the savings as you built that up? If you're 40 or 45 years old, targeting an age 55 retirement, and you say, well, I can afford in my cash flow to max fund my 401k, and maybe my spouse can do the same. The question that maybe needs to be asked is, well, how are we going to handle that 5-year gap between 55 and 59.5, right? And
so you should know in advance.
So you should know in advance.
So you should be working with a planner, not when you're ready to retire, but leading up to retirement.
Which gets to the point that we get asked a lot of, I don't know when I should talk to a planner, right? And I think industry averages, most people reach out to a planner for the first time about 6 months prior to retirement, right? Not a lot we can do.
It's that old joke of, I'm going to retire in a week. I haven't saved a dime. Here's your chance to become a legend.
Right. Exactly. Yes. Yes. So starting early obviously is a big piece of that. But, for those that think about retiring early, it may be the question of, okay, should it all be going into a 401k?
Right.
Should somebody be setting up non-qualified assets outside of a 401k that aren't subject to those types of penalties? Should they be looking at funding the Roth side of a 401k or Roth IRA? Because those bring the benefit of access to contributions prior to 59.5 without the penalty.
Sure.
Right. Ultimately, for those that have accumulated everything in pre-tax, it's not the end of the world. Right. There's some provisions within the IRS code 72T that you can set up substantially equal periodic payments. SEPP, which comes with its own set of complications.
Yeah, I mean, that's usually my last resort.
Right.
But it is possible.
It's a mechanism.
So I'm 55. I go into my advisor and I'm ready to roll my 401k over. Should I do that, or are there some things I should look at first?
I think the answer is always it depends.
Yeah, right.
Right. It's really going to boil down to what's your strategy to whatever extent that it makes sense, and to whatever extent that you can, to really seek to avoid that extra 10% penalty that you're going to pay.
So if my plan has a provision that I can take out the funds without the 10% penalty, then I need to leave it in the plan, right?
Correct. At least a portion sufficient enough to handle your distributions.
Right.
Yeah. Because for a lot of people, they, once you leave an employer, you kind of want to cut ties from it.
Right. And the investment options are limited. So there's certainly benefits that are in people's interest to get control of those assets on their own. But it absolutely needs to be looked at in terms of, does the potential exposure to that extra 10% penalty overweigh the limitations that come with leaving it in the plan? Sure.
Right.
Okay. So we settled that. Now I'm 62. Do I take my Social Security or do I let it cook?
Well, again, it depends, right? Yeah. So, the answer is always it depends.
Yeah, we know.
I think again, if you read the general guidance out there, it generally always says, well, you should leave Social Security as long as possible and get the biggest payout that you can.
Right.
Because each year you leave your benefit alone, it increases roughly 8%.
Right.
I think is the math. There's some cost of living adjustments and things of that nature in there. For me, from a planning perspective, one thing that I've always been challenged by in looking at that conventional wisdom is, why would you leave it there? And again, if we go back to the average person where Social Security is the bulk of their retirement income for the household, and typically that's two people, and there's not a lot of liquid assets outside that, right? We don't have millions of dollars in a 401k. We don't have $100,000 sitting in a checking account. one of the considerations that comes into play is eventually one of those spouses is likely going to die before the other, right? And so what is the surviving spouse going to live on in that situation?
Because they only have one Social Security check.
Because they only have one Social Security check. And it'll be, the bigger of the two is what will continue for the surviving spouse. And if that's your situation, you really do have to look at making sure that that one remaining check is going to be big enough for the spouse.
Right.
And that becomes, for a lot of people, the primary motivator or the primary justification to say you should leave it, right? But for those folks that have accumulated sufficient assets, that isn't necessarily a primary motivator, right?
Right.
There's other assets there to offset that loss of income from losing one of those Social Security checks later on in life.
It also depends on if you're going to keep working, right? Because you're penalized if you earn too much money under age 65.
Correct.
Also, your tax rate might allow you to do some Roth conversions. If you have Social Security coming in, that might cause extra taxes on your Roth conversions.
Right.
So there's a lot of little planning considerations in there that you need to take into account.
It's the classic example, and everything we're kind of touching on here is issues with tax, right? It's issues with the IRS. And I think one of the overlooked factors in our industry broadly when people are working with clients is questions involving tax can't really be solved in a vacuum.
Right.
I can go research when should I draw Social Security, and I can find an answer. Right. And it's generally going to tell me to wait. And the justification is, well, the benefit's bigger. Well, no kidding. Right.
But I've read several studies recently that, actually look at what really happens to people.
Correct.
And most people aren't better off by waiting.
Correct.
They die too soon, or you forget about the fact that you would have been bringing in all that extra income. I think the crossover rate's usually around 13 years.
Right. Correct.
After you start taking Social Security. So that's age 83.
Right. And then you just compare that to life expectancy, right?
But you're taking more of your assets out because you're not drawing Social Security, and you're forgetting that you might be getting 7 or 8% on those assets also. So you have to take that opportunity cost into account as well.
Right. And I think, when people look at that crossover, because again, if you go look at the average thing, that's what it'll talk about, right? If you don't draw your benefit, let's say it's $2,000 a month at 62, and it's going to be, $3,000 a month at 67 at full retirement age. Keep the math simple. Okay, so over those 5 years, you've left behind $125,000 or $130,000. Okay, well at 67, I get an extra $1,000 a month. Right. To your point, do the math on that. It basically takes you 13 years to get that back.
On a dollar for dollar basis.
On a dollar for dollar basis.
But it doesn't take into account the opportunity cost of the assets that you've had to spend.
It doesn't take the opportunity cost. It also doesn't take into what's the value of those dollars at that point, right? $2,000 today versus $2,000 13 years from now. Everybody knows, just look at the last 5 years, right, at what's happened. So, if you do the nominal dollar crossover, it's about 13 years. Right. If you adjust for the purchasing power of those dollars, you know when that crossover is?
No, I don't.
Because I've actually done this.
Okay.
It averages, if you assume about a 2.5% inflation rate, okay, which clearly is well below what we've been experiencing, at least in recent years. But at a 2.5% inflation rate, the crossover point is between age 92 and 94 for the average person.
And how many people live that long?
Not many.
That's right.
Right.
Yeah. Right.
So, to your point, if people are in a position where they have access to other assets, it's very likely that they may be better off to take Social Security as soon as they can get access to it when a dollar's worth a dollar.
Right.
Right. But that isn't just a blanket answer, because to your point, you've got to look at what are the other things that you're planning to do. Are you doing Roth conversions? Do you potentially plan to go back to work? Right.
Also health insurance.
Health insurance.
Yeah. So if you're buying on the exchange, you might, eliminate your tax credit by drawing Social Security.
Correct. Yeah. So there's a lot that goes into that. And again, it's not as simple as just go out and figure out, well, what should the average person do?
That's right. Okay. So the next big milestone is what? 65?
65 Medicare.
So what happens then?
So that's Medicare enrollment.
Right.
Which is, Medicare is the thing that I think a lot of people think is really confusing. There's a lot of parts, right? And there's a lot of letters. There's Part A and there's Part B, and then you got supplements of A and B and G and F and D and all the things, and Part D and prescription drug coverage and all this stuff, and it's intimidating. broadly speaking, though, it's pretty simple, right? Once you understand the system and how it works, it's relatively simple. Probably the biggest mistake that we see people make in regard to Medicare has to do with failure to plan for the income brackets that start to activate the IRMAA surcharges.
Right.
Because those are 2 years in arrears. So, your income in 2025 is going to basically establish any IRMAA or surcharge that you're going to have to pay in your Part B premium and your Part D premium in 2027.
Right. So we have to think ahead.
So you have to think ahead.
Yep.
Now, for people that have a transition in there is an appeal process where you can adjust that in real time. So it's not a situation that if you're working at 63 and you have high income and, you're staring down the barrel saying, oh my gosh, at 65, I'm going to have a huge, IRMAA surcharge of $200 or $300 or $400 a month, because it can be pretty substantial for people. But if you retire at 64 or you retire at 65, you can appeal that.
Okay.
And they will adjust and remove that IRMAA if you've had sort of it's not called a qualifying event, but if you think of it in that term.
So one mistake I see on the IRMAA side is that people make what I would consider bad decisions just to avoid the IRMAA surcharge.
Correct.
It's just an additional tax.
Right.
So if you're trying to do a tax strategy, you need to calculate that IRMAA surcharge as just a percentage of whatever it is that you're trying to do.
Right.
And if you're trying to do $1 million Roth conversion, $400 a month is, very minimal.
Right.
In comparison to the total tax that you're going to pay.
Yep.
So you can't just say, the IRMAA limits are a strong line that can't be crossed.
Right.
You have to do the math and see what's the real impact on your effective tax rate, right?
Well, it goes back to kind of a fundamental principle, I think, in retirement planning and talking with people, which is if your goal is always to avoid the worst outcome, you can do that, but what's the trade-off, right?
Yeah.
We run across people that, financially are well within their means and capable of retiring at 55 or 57 or 60 years old. Will they have to draw on their assets? Yeah.
Right.
And you model it out and they're like, but I'd have more if I just worked 5 more years.
Yeah.
Right. Well, the answer, the facetious answer to that is, well, yeah, you'd have more if you just worked to the day you died.
Yeah, exactly.
Right? But is that really what you want to do? And, when you think about things like IRMAA, if your sole goal is to avoid IRMAA, you may well have negative impacts that far outweigh the $100 or $200 or $300 or $400 a month that you're going to pay in IRMAA.
Yeah. I mean, if your RMD goes up by, 100%,
right.
You're probably worse off by not paying the surcharge.
Yep.
Right.
So IRMAA is one of the big things that we see people just not factor in, right? Most people, frankly, aren't aware of it.
Do you want to give a clear explanation of what IRMAA is, just for people that don't know?
Yeah, absolutely. So IRMAA is basically a provision of Medicare that is designed to, we'll say, extract additional premium out of high income earners.
Okay.
Right. So once you start getting into the income levels, the adjusted gross income levels of, say, 150, 160,000 and above.
We'll have John put a slide
we'll get a slide of the breakdown, because it's in a way they're almost like their own tax brackets, right? So you move into these different income levels where essentially the Medicare system says, well, you need to pay more for your Part B premium as well as your prescription drug premium.
Right.
And they can be pretty steep. I think the highest one is well into the 400s of a monthly premium.
And that's for people for married couples that make over $750,000, I think.
Correct. Yeah. Yep. So, which again seems far out of reach, but when you start talking to folks that have accumulated a lot of money into pre-tax retirement assets, and you start trying to solve for current and future tax liabilities, and you start talking about maybe, again, to the average person would sound like obscenely large Roth conversions, you start jumping through these brackets really pretty quickly.
Right. Yeah.
And so, it's, to your point earlier, it's a tax without being called a tax, right? And it just needs to be factored into the overall effective tax rate conversation that's being had as you're doing tax planning, and trying to figure out what makes the most sense, what allows me to keep the most of my money, not just today, but in the future, what allows me to leave the most money to my heirs, And then how are they going to receive that money, and what do they have to do with it?
Right.
Right. Because that's the other side of it.
Because someone has to pay taxes on it someday.
Somebody's going to pay taxes, right? There is no, there is no silver bullet. Sorry. There's no silver bullet where we can completely avoid tax, right? At least not a legal one.
I mean, other than giving the money away to charity, but then you don't have the money.
Correct. Yep.
Which actually leads us to the next date, which is 70 and a half.
Yeah.
Which is now you can start doing direct charitable gifts from your IRA. Even if your RMDs haven't started yet, the direct charitable gift thing was never updated.
Right.
It's still stuck at 70 and a half. So how does that work?
Yeah. So basically the idea there is it's a way of getting money out of your IRA without it showing up on your tax return. Right. So it can help with reducing exposure to IRMAA and things of that nature because it just doesn't show up. Right. Mechanically, all it is instead of you taking a distribution from an IRA, putting it in your checking account and writing a $500 check to your church or $1,000 check to your favorite, animal care nonprofit or what have you. Instead, you're just going to have that check sent directly from your IRA, payable to the nonprofit.
Right. The important thing about that is it never hits your AGI.
Correct.
Right.
Yep.
So it never brings Social Security in for taxation. Whereas if I take it out of the IRA and then give it to the charity, it's in my AGI. Correct. So that could cause my Social Security to be taxed.
Correct. Yeah. Could cause Social Security to be taxed. Could trigger your IRMAA brackets.
Right.
So there's a lot of benefits. And again, what it requires people to do is sit down and plan ahead. Right. A lot of times, I think we give to charities kind of spur of the moment, even though we know we do it every year. Mm-hmm. Right. If you've given $2,000 every year to your church come Christmas time to help offset whatever it is that they do in the community, we write the check every year. Well, if we know we do that, that's sort of a prime candidate for something for these direct charitable gifts.
Yeah. And so then the last sort of horizon here in the retirement planning age spectrum is RMDs. Mm-hmm. Right. So now I've gotten to the point where the government says, okay, it's time for us to start getting our piece. Yep. So what does that look like?
Yeah. Well, this is the thing that for those that save really well, and I would say it's for people that realistically are looking to retire before 60, it means they've saved really well. Right. And it probably means they live a fairly modest lifestyle, or certainly well within their means. And so this sort of sneaks up on a lot more people than what you would expect it to, right? Right. And again, most people, we can look at our net worth statement, right? We know what we're worth today. We know what's in our accounts. But most of the time, we don't look out 10 or 15 or 20 years into the future and apply just some reasonable estimations or growth projections around that to say, well, what does this look like as I've taken my distributions, as I've paid my taxes, as I've done Roth conversions, I've done whatever all these strategies are. Well, what does this look like by the time I get to 75?
Yeah, and I mean, you can use the rule of 72, right? So at a 7% return, you're going to double every 10 years.
Correct.
So if you're 50 and you have $1 million,
right,
you're going to have $4 million by the time you're 70 if you don't touch it.
Correct. And if all that money has been accumulated in a pre-tax account, in a 401k, now it's sitting in an IRA, all of a sudden I get to 75 and I'm living a nice lifestyle. We're collecting $40,000 or $50,000 from Social Security because, again, if we're in that position, we've probably got higher income. We probably get a little higher Social Security amount. Maybe I'm living on $100,000 a year. Pretty reasonable, right? All of a sudden, I've got $4 million sitting in my account at 75 years old, and the government's going to say, "Well, you've never paid tax on that. We'd like to get it."
Yeah.
Right. And what ends up happening is we look at the December 31st balance in your pre-tax account. The IRS has an RMD table. It's basically a formula that you take your year-end balance, you divide it by the RMD factor that applies for the year, and that tells you what you have to take out next year. And you say, well, but I don't need all that. And the IRS says, well, we don't care because they want that to flow through your tax return to collect your money. So if you're sitting to use your $4 million example there, you're probably looking at a required distribution somewhere between $150,000 and $170,000.
That's going to change my tax return.
It's going to change your tax return. So if you were that person that maybe had a tax return where you were putting $100,000 through it, and live in retirement comfortably. All of a sudden, with that one tick in the calendar, now your tax turns over 200,000 again. Right. Which is maybe a level you haven't seen since you were working. And so, immediately we've blown up the assumption that most people accumulate money under, which is I'm in the highest tax bracket today while I'm working that I ever will be. And once I retire, it will go down. Right. Which it does for a lot of people for a while.
In the early years.
Right. Until it doesn't. Right. So now what happens? I've got an extra, say, $100,000 that's coming out of my 401k that I'm having to pay taxes on for no other purpose than the government says that I have to. I'm not probably going to turn around and change my lifestyle suddenly at 75 years old to start spending that, right? So what am I going to do? I'm probably going to set that aside and put it into a non-qualified taxable brokerage account, right?
But now it's going to kick out dividends, interest, and capital gains.
Correct. So what have I done? I've effectively started a tax snowball, right? Later in my life. And so every year, your RMD factor goes up, right?
Because life expectancy
goes down, you have fewer years left and they want all the money out, right? So if the distribution rate is roughly 3.5% of your balance at 75, the next year it's about 3.6%, and then 3.7, and then 4, and then 4.5. Meanwhile, that account, if it's sitting there earning 7%, is still growing. So I've got a bigger balance and a bigger distribution, and all the surplus is flowing over into an account that's generating its own tax liability. And all of a sudden, my effective tax rate that was very nice and maybe single digits or low double digits, all of a sudden starts to ramp up very quickly. And we start seeing people in those later years of life where they're back well into the 20% in effective rate. And you can get to the point, and I've seen this, you can get to the point where the tax inefficiency of this whole snowball is actually overwhelming pretty much all the growth of your portfolio. Which is incredibly inefficient. So, that's just something that, again, if people, I think most people are aware that eventually I have to start taking money. I think most people are aware of RMDs. I don't think most people, especially those that have saved well, have ever sat down to really look at the numbers behind it. Because when you see that type of bubble coming, it should start to drive behaviors today. It should start to influence the question today of, well, should I be using pre-tax 401k? Should I be using Roth 401k? Should I be considering conversions, a lot of times you start to see that at 45 or 50 years old, not at 75. Because by that point, it's kind of
too late. Yeah, there's not much you can do at that point other than direct charitable gifts or go way above your tax rate this year for Roth conversion so that you can try to reduce future taxes.
And then, on the back end of all this, there's no age to it, but the reality is there's an end date to this game that comes into play, which is we die. And these monies that we've accumulated go somewhere. For most people, it's probably kids or grandkids. And kind of back to the Social Security question, are you better spending the Social Security check or are you better spending down your assets? Well, you can only leave one of those to your kids when you die. So spend the Social Security money, keep your own. But then when we start to look at all this, if we're leaving substantial sums of pre-tax money to our heirs, with the recent changes in RMD treatment for inherited assets that are non-spousal, so leaving to your spouse, everything just kind of continues on. But when that second spouse dies and those assets distribute to your kids, they have to take that out of the account within 10 years. And so if I've accumulated a $4 million pre-tax account and I'm leaving that to my two kids, they're getting $2 million a piece. They've got 10 years to take that out.
So $200,000 a year at least.
$200,000 a year at least. And if you think about just the age at which people typically pass away, well, how old are your kids then?
They're in their peak earning years.
Right? So they themselves, without what you're leaving them, are probably staring down the barrel of their own 20+% effective tax rate. And now all of a sudden, you're going to leave them this very generous gift through inheritance that is going to spike their own income by $100 or $200 or $300,000. Right. And very quickly, when you start to look at this math, you see how the money that you're leaving to your kids in that format, they're really only going to get about half of it.
Right.
And so that $4 million that you've accumulated that you feel great about leaving to your kids, your grandkids, the reality is by the time the taxes are addressed out of it, you're really leaving about half. Right.
And we could have been proactive and planned and done some things in advance to make that higher.
Right. Because, if maybe starting at 50 or 55 or even 60 years old, if we start examining this and looking at the tax consequences, and maybe we start some very aggressive Roth conversions, by the time you pass away, maybe there's $2 million in a 401k and there's $2 million in a Roth, right? Because we've converted. Well, now all of a sudden that $2 million is still subject to the 10-year rule. They've got $100,000 a year they have to take instead of $2 million. You've left them $2 million of Roth. They have to take that out with, by the end of 10 years too, but there's no tax.
Right. Plus there's some income to pay the taxes also.
Right.
That's tax-free.
Right.
Yeah.
So, just when you look at that life cycle, fundamentally, all of this really comes back to the question of taxes, right? And, people work really hard to save, right? They sacrifice. You don't take the trips. You don't buy the house. You don't do things to set aside the money to afford to eventually stop working. And I think from a planning perspective, ultimately, our goal is to help people keep as much of that as possible.
Yeah, the old saying is that it's not what you make that matters, it's what you keep.
Right.
And I think a lot of people don't focus on that.
Right.
They focus on minimizing this year's tax return, and they forget that 20 years from now, they're going to be paying double the tax rate.
Right.
Yeah. So, all right. So let's summarize. So if you're retiring before age 59 and a half, you've got some planning considerations that you probably need to work with. Well, actually, let's go all the way back.
Yeah.
If you're in your 20s and 30s, you need to start having some projections to tell you whether you're better off saving pre-tax or after tax.
Right.
And what types of accounts to be saving that in.
Yep.
If you're retiring post 55 but pre 59 and a half, you've got some considerations that you really need to take into account. At 62, you need to decide whether it's better to start taking your Social Security now or later. At 65, you need to plan for Medicare. And then at 70 and a half, you can start doing charitable gifts. And then once your RMD age begins, then the planning has sort of come to a crescendo. There's a few small things that you can do,
Right.
But everything that you've done for the last 74 years finally comes to a head.
Yep.
Is there anything that we sort of missed there in the summary?
Not really. I mean, that's really kind of the gist of it, right? Okay. There's obviously, there's considerations for people that are charitably inclined to try to help maybe manage that. There's donor advised fund considerations for people that really want to be, looking at more sizable.
And private foundations, we've been seeing
more of those.
Yeah.
So there's definitely ways that, people can think outside the box about the impact that they want the money that they've accumulated to make, right?
Right.
First and foremost is obviously making sure that, you yourself are taken care of, right? And your spouse is taken care of. Second for most people is probably their kids, right? Or their grandkids. But at a certain point, you really start to open up the conversation around, opportunity to benefit the community in ways that maybe you never thought possible, right? It's funny how wealth accumulation, I think, sneaks up on people.
Yeah.
There's the old term, the millionaire next door.
Right.
Right. And I think the Midwest, obviously, which is where most of the folks that we work with, there's a lot of that. Right. And it's people that live modestly, they live well, but they live within their means. And, we hear all the time, I never would have thought that I would have this. Right. And that's fun from a planner perspective when you get to experience that with a client.
But you can't let it sneak up on you. You got to start planning early.
You can't let it sneak up on you.
Right.
So, and I think that's true of everything. When we started this off, the question was, what mistakes do you see people make? And I think what it really boils down to is the mistakes boil from not planning.
Right.
Right.
Or starting too late.
And I think the idea of late, it's really never too late.
Right. Yeah. Right? But the earlier, the better.
The earlier, the better. The way I've had that conversation with clients in the past is, what's done is done. Right. And it got you to where you're at.
Right.
And that's great. Would it have been awesome to have started this conversation 10 years ago? Absolutely. But guess what? Can't go back in time.
That's right.
Right. So what are the strategies that can come into play at whatever point you jump into the process that really dive into, kind of starting from the end and working back, right? What does this look like at some of these major milestones? And then working that back to today, whatever today is, whether that's at, 30 years old or 61 years old, right? What are the things that can happen today to try to make this as efficient as possible? So,
very interesting.
Yeah, it's fun.
Yeah.
It's like a big puzzle.
Yeah, it is.
So I don't know. What else we want to?
I don't know. I think that's probably good.
Okay, awesome. Well, hopefully that was kind of an interesting walkthrough, and I think it's like a lot of things in what we do, Alan, it's there's no like direct short answer that works for everybody.
There's no royal road.
There is not, right? Biggest word of caution, be really careful about general rules of thumb.
Right.
Right. Be really careful about taking advice geared for the average. Go read your article on
average.
Average.
Yeah.
Fascinating.
It's a boring read.
I don't know. I enjoyed it.
All right, good. At least someone did.
me and your mom.
That's right.
We were the two probably that read it, but no. So anyway, with that, we'll kind of draw us to a close. Alan, really appreciate the conversation.
Yeah, thank you.
Next time we're going to get back to, me grilling you and not the other way around. So, but this was fun. So appreciate it. And thank you for tuning in for our 20th episode here. As always, we welcome your questions, whatever they may be, whether it's market related or planning related or just curiosity about some subject matter that's flying through the headlines. So
Sure.
Thanks for joining us. And until next time, take care.
Thank you.
Thank you for joining us for this episode of the Point Podcast, sponsored by Basepoint Wealth. As always, you can submit questions or topics you'd like to hear discussed to info@basepointwealth.com. Be sure to subscribe so you don't miss any future episodes. Basepoint Wealth LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.